Hi, this is CindyWang. Uh, the company I'm presenting today is Raymond James Financial Inc. It's a financial service holding company headquartered in St. Petersburg in Florida. It's listed on New York Stock Exchange as RJF since 1983. The company has 6,596 financial advisors, and their stock price is $53.92, and uh, the market cap is 7.76 billion. Financial industry is highly sensitive to macroeconomy, but IGF is probably benefit from the volatile economy right now because in this situation, usually people's demand of financial planning is higher. When when comparing industry average, RJF has slightly higher gross margin and operating margin. The EPS is about 60 cents higher as well. And RJF has four main segments. The private client group, which mainly works on financial consulting and sale of insurance and annuity products. This segment generates two-thirds of the company revenue from commission and fees for providing services and products. They also have a capital market segment that works on investment banking, and asset management and RG Bank are smaller segments. And the the valuation of I focused the valuation on private client group because it dominates and leads the growth of RJF. RJF is RJF is working on recruiting and acquisitions to grow the number of advisors as well as the client base right now, and it's also expanding their services by providing online financial services. Um, Finally, they are expanding geographically into different locations where they didn't have offices before. Regarding the accounting analysis, I wanted to focus on the estimates and valuation. Um, the, there are two larger receivables I noticed, and the bad debt and loan loss estimates are actually the number is actually 0.19 of the total of the two larger receivables I noticed, which I think it's probably too low. So I actually increased the percentage slightly to 0.25, which is pretty still low, I think. And the net income is decreased by 1%. So I can see the change in bad debt expense can make the big difference in net income. And the other thing I wanted to talk about is the valuation. For RGF has level 1, 2, 3 security assets, which are either valued on fair market value or through pricing models. But these are totaled at 5% of their total assets. So when there is adjustment necessary, the amount is probably immaterial. Regarding the ratio analysis, RJF is increasing in net profit margin and total asset turnover, as well as ROE in basic DuPont model, but the leverage ratio is decreasing. So it looks like RJF is trying to improve the productivity by improving operations. In the advanced DuPont model, however, um, their return on net operating assets is slightly increasing but pretty stable, and the decreasing asset turnover is probably the reason of that because their net operating margin is pretty stable. Um, Also, we see the decrease in net borrowing cost, which is faster than the decrease in return on net operating assets. So that causes the spread to be increasing. And for ROE, it's still increasing, but number is not not big. So it looks to me that although the it looks to me that although the ROE is improving, the improving is probably not coming from the operation. It's more likely that it's coming from the reduction in the borrowing cost. So the quality of ROE is probably not that good because we usually expect the improvement coming from operations. And I also wanted to bring it to your attention that the company had some loss in Canadian um, business because of the lower oil price hit Canadian badly. That's why we see a ROE decrease in 2015. In terms of forecasting, I also used PCG Group's number as a focus point to do the assumptions for revenue growth, etc. And I factored in the number of PCG advisors and average revenue per advisor together to bring into the total revenue growth rate. And I came up with the average growth rate, revenue growth rate of 13%. And also, there are more and more experienced financial advisor getting close to the retirement age. So the new advisors usually takes about over a year as far as I read about to pick up the skills, and so I would say there's a lowering. There's a possibility that the revenue growth rate is lowering in the coming few years because of that. And also in March 2016, President Obama signed off a fiduciary duty law for financial advisors that's estimated to lower the returns of overall financial institutions by 1% in the report I read. So when I factored those two things in the assumption, I lowered the growth rate by 1/3. I thought it's reasonable, and it left me with 8.8%, and I decreased it through 10 years to 3% at terminal year. So regarding the expenses, I assumed that variable expense is 80% of the of sales. That's calculated from historical data, and fixed expense, I left it with the rate eval calculates because I didn't see a lot of adjustment I needed to make. And for acquisitions, I didn't adjust for them because if you look at the press release of RJF, it looks like they actually do acquisitions more frequently than some of other businesses, and a lot of them are um, done because they're buying the advisor team and their clientele. So I treated it as part of the operation. In order to calculate the cost of capital, I took beta of 1.51 from Google Finance, and the risk-free rate is 1.762. Sorry, is 1.762%, and equity risk premium is 5.75% according to the recommendation of KPMG 2016 report. And I came up with cost of capital of 8.4%. For cost of debt, the company's annual report is saying that 1.75 is their borrowing interest rate, but eval doesn't take that low, so it doesn't take that low number. So the lowest I tried is 3.2 for calculation, so that's what I put in there, and I came up with the value per share of 65.61. Next, I did the sensitivity analysis. I decreased the 2016 revenue growth rate by 4%, and the value per share decreased 5.8%. So it looks like these two are changing hand in hand. And I also tried cost of equity rate. I increased it by 1.6%, and the value is decreased by about 25%. So that's a lot. And I also changed the variable cost percentage over revenue, and I increased it by 2%. The value per share decreased over 10%. So these probably cost of equity rate and cost of variable cost are probably the two elements that RJF want to look more into uh, when they want to increase their return, because it looks like it will be efficient if they do something about them. And I also listed the EPS I calculated and the EPS from the analyst forecast. I found NASDAQ here. The yellow part is the ones from NASDAQ, and mine came out higher and then gradually got close. And then also my valuation is higher than the stock price, which I think is probably because of the pessimistic macroeconomic outlook right now. Um, some people are saying it's already the peak of the economy and it's gonna contract soon. So that's probably why the stock price is low. But we did see that RGF Q2 EPS is higher and their stock price went higher. So maybe next quarter will be even better. So this is my presentation. Thank you so much for listening.